Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. And I have a kind of an interesting video today, one that I'm really kind of excited about doing because it really deals with one of the real pet peeves I've had as an investor for almost 5 decades now, working with investors for almost 5 decades now. And, the title of this video I'm going to call Value Investing Requires Intelligent Patience. And intelligent patience means having patience with your investments based on a focus on the fundamentals while trying to do your very best to ignore very volatile stock prices. My Dividend Kings do a podcast every Friday, and it's or at least every weekend. And this particular weekend was talking about the biggest mistake that investors can make. And what they were really doing, they were quoting and providing a lot of good statistics. My co-founder, Adam Gallus, was the one that I think really put out some really good data, so I give him credit for most of this. But I do want to point out some of the statistics that he shared. And he pointed out that J.P. Morgan Asset Management did a study where they found out that 7% of 12-month returns are driven by fundamentals, only 7%. And of course, I'm a fundamental value investor, also known as Mr. Valuation. But in the short run, and we're talking about a month, in this case, talking about 12 months, the short run, only 7% of returns will often be driven by fundamentals. And by fundamentals, we're talking about yield, growth, and value, or starting yield, growth, and value. And 93% of the returns can be attributed to sentiment or luck. In the short run, as Ben Graham so aptly once put it, the market is a voting machine. People are voting their dollars. Keep in mind, the liquidity of the stock market is really where the liquidity comes from. And that liquidity is one of the great advantages of investing in stocks. You can buy and sell your stocks at any time. But with that liquidity comes volatility. And, there are certain academics that like to define risk as volatility. Now, I think volatility itself isn't risk. It's how you as an investor react to that risk. And that's where intelligent patience come on. But now these studies went on to also point out some other very interesting, I think, and important statistics. 43% of 5-year returns are fundamentals or driven by fundamentals. And it takes 11 years for 90 to 91% of the returns to be driven by fundamentals. Now, that's a true long run. A decade is the long run, but I want to be careful with statistics like that because they can mislead. That doesn't mean that it always takes 11 years for fundamentals to manifest into your returns or for the stock price to reflect fundamental value. It can oftentimes be very, very shorter, but in the general sense, for all stocks considered, it would take about 11 years. But in the long run, as Ben Graham also said, the market is a weighing machine. It's the weight or the substance of the business, the earnings, the cash flows, the sales, the dividends, the business results that actually determine the real value of a business. And, I like to define the long term as at least 3 to 5 years of what I call a business cycle because it takes time for businesses to grow their business. They only report quarterly, or as a friend of mine used to quip, businesses report their earnings 3 times a year or quarterly, whichever comes first. And there's, by the way, that's, he was trying to be cute. But the point is, it's not every calendar quarter because some stocks have different fiscal years. They have January and February fiscal years and so on. But even those companies will report roughly, 4 times a year. So you're only getting good information. But the point really is that it takes time for companies to grow. If companies are growing at 10%, it takes approximately 7.2 years, the old rule of 72, for them to double their earnings. And that's at 10% growth. At 20% growth, it only takes 3.6 years. But there aren't many companies that grow at 20%. In fact, you're hard-pressed to find a lot of companies growing at 10%. But, so if you flip that around, if you look at, say, a 7% grower, it's going to take 7 into 72 would be, roughly, a little more than 10. So it's going to take the 10 or 11 years that we talked about before you see earnings double. And what that means is before the value of the business doubles. But in the short run, as we all know, stock prices can go all over the place. So, we want to be careful with that. And, the key is that we want to look at not at stock prices, but at fundamentals first. So let's go ahead and go into fast graphs. Now I'm going to do something a little risky today. I keep talking about the new version of fast graphs. I'm going to utilize it in today's video, and I'm going to attempt to show you this because it's very fast. It's going to be kind of a disjointed video. I'm not focusing on any one company here. I'm focusing on the relationship between fundamentals and stock prices, and I want to point out things about fundamentals and stock prices. I do that. So the first thing is that, as I say over and over again, fundamentals drive returns over the long run. So I'm going to take price off of the graph. I often do that. And we're going to look at FedEx here, and we're going to look at its long-term earnings growth. I'm simply going to use operating earnings in every one of these for simplicity and quickness here. But you can see this is the profitability of the company, and you can see the profitability has risen and fallen. Of course, this is COVID, but generally it's been up. Now, when I put monthly closing stock prices on this graph, which is this black line, you see that stock prices tend to go where the company's earnings go. And you can see that with all these different iterations. During a period of dropping earnings, we have dropping stock prices. During a period of rising earnings, we tend to have rising stock prices. Sharp drop in earnings, a sharp drop in stock prices. But the point is, in the interim, when you're looking at this in the interim, if I take earnings completely off the graph, you can see the stock prices are always a jagged line. That's simply the nature of the beast, if you will. All right. So, in the short run, we're dealing with this volatility. So now, the point I want to get as here, though, is let me put the graph back together here. If I look at a stock like Apple Computer, one of my favorite companies on the planet, this is a case of a company that people love. Okay. Everybody likes Apple. I like Apple. But the truth of the matter is, when you're looking at Apple, you can see that the stock price correlated with its fundamentals, and fundamentals were growing at about 18.75%. So I'm using a orange line on this graph, a PE of 18.76. We'll call it 19 for round numbers. The blue line is a PE of roughly 16, 15.9. And you can see that Apple traded at that 16 PE or less for most of this time. That's with an 18.75% growth rate. Forecast growth rates are going to be less than that. Okay, and let's go into forecasting real quickly. Forecasting growth rates are expected to be about 12%. Now, when you're considering this is a $2 trillion company, that's very, very fast growth. Okay, and that's where people get hung up or get caught up. They get all caught up in the growth, but they forget about they're getting yield and they forget about value, okay? Because as fast as Apple's going to grow in the future, and 12% for a company this big is extremely fast, that does not justify this level of price. What would be much more realistic would be this 15 or 16 multiple on a company growing at 10 or 12% a year. That would be a very realistic multiple, but keep in mind, it takes time for the company to grow the business. And right now you're prepaying for future earnings far out into the future if you're investing in Apple today. Now, if you bought Apple when it was reasonably valued, where the yield and the value made sense, then you had a really tremendous investment because you had your money participating in the full value of the business. And that's what it's about. I love Apple. I'm not trashing Apple. I think Apple is one of the best companies on the planet, but I do believe the market is a voting machine in the short run, and it simply has Apple being, valued at a ridiculous valuation here. But I also want to talk about this, how long it takes valuation to manifest. So I'm going to look at a company here, Medtronic, and I'm looking at valuation from two perspectives. The orange line represents fair value or intrinsic value on the graph. So I don't want to get into the details of that. Those of you who follow my work for a long time know I have a lot of reasons for that. But in this case, I've got a 15 PE ratio. That orange line is a 15 PE ratio. So when the stock is trading above the orange line, the PE ratio is much higher than 15. When the stock is trading below the orange line, the PE ratio is much lower. Now, this whole idea about ignoring valuation and focusing on stock price and how long it takes fair valuation to manifest can be shown in this one example here. I go back into, May of 2000 back here. Medtronic was extremely overvalued. The stock was trading at a PE more than 56 and a half times earnings. So, and the price was $51.63. If I go all the way out here, more than a decade, I would have actually lost money holding Medtronic. All these years, I'd have lost money holding Medtronic. And I'm going to use my scroll bar here if I can and bring this back as close as I can get to it. During a time when the company grew their business by double-digit rates, 10 to 12% a year. Okay, 10.5%, 11% a year, but yet you lost money. In other words, the earnings grew every year. You can see this wonderful record of growing earnings and this wonderful record of growing dividends, but the stock was overvalued. Now, in this case, it took better part of that 10 or 11 years that I quoted earlier in this video for valuation to manifest. In fact, it took the Great Recession for it to happen. But then another interesting thing happened here with Medtronic. Once the recession came, then the stock became undervalued, and it traded at this very low PE ratio for the better part of the next 5 or 6 years. But again, it took several years of low valuations. There wasn't any money to be made, a little bit, obviously. 8 or 9% is not, obviously chicken feed. But the point is, you really didn't get the full benefit of this company buying at these low valuations. But in, a course of, let's say, 1, 2, 3, 4, 5 years, this company's stock price moved back into fair value. So if you'd have bought it here at its low valuation of a PE of 10 and held it through to the time it hit fair value, you'd have made almost 18% a year holding this terrific stock. But the point is, the price in the meantime, look at the volatility of the price. You would have had a period where the price dropped, from March of 2010 down here to August of 2010. The stock dropped, 30%. You actually had a annualized return of over 57% because this happened in less than a year's time. So that's pretty significant volatility. And then, from there we had the stock, go through this nice little rise here. This is the short run. This is the voting machine that Ben Graham talked about. We had this 30% rise in just a matter of a few months again, followed by another drop. And then we had all these drops up here. These drops, this volatility can happen very, very quickly. But it took time for the company to grow earnings from $2.60 up to, and double it to $5.22 roughly, over this 7, 8, 9, 10-year period, growing at about 9% a year. That's the message I want to get across. So the point is, when I take I take price off of this graph and look at fundamentals, this has been a terrific growth, a very consistent growing company with a very consistent growing dividend. The secret was I had to get the price aligned with value. Now, once I got price aligned with value, I could make some really great money owning this stock. Double-digit rates of return over this decade. But when I owned it during this decade back here, where I was way overpaying for the stock, I could have owned it for a decade here and lost money. So the point is, valuation matters, and the principles are current yield, valuation and growth. Those are the things that are going to ultimately be the holy grail, if you will, of investing. And when you're looking at, a stock like Medtronic, when it was overvalued here, the dividend yield was under 1%. 0.5%. When it got really inexpensive here, the dividend yield was 2.75%. Today, the dividend yield is 1.8%, which is getting below that high yield. So the point is, you want to buy stocks when they're attractively valued. That's really the key to making investments. Now, there's these meme stocks and these currency stocks out there. There's all kind of crazy stuff. I don't know anything about these companies. I'm way too old to be investing in this kind of stuff, but some of you younger people aren't. But this is a classic example. Look at the incredible run that this stock had from October 2020 to February of 2021. What is that? 5 months. Okay. This stock was up just astronomical. And then all of a sudden now this year, looking at it from February of 2021 till now, the stock has dropped 48%. This is that short-run voting machine. This is the unpredictable nature of short-term volatility. This stock isn't even making any money. There's no profits on this business at all. And yet, if you'd have bought it on its IPO, I also want to point out, you would have owned it for several years, losing a substantial amount of your money before you had this massive pop. There's nothing about this that makes it predictable or rational, and that's not intelligent patience. It's crazy to own a stock that's losing money every year, at least in my opinion. Now, here's another one that's one of these meme stocks that actually has, a little bit of mojo actually going for it. Again, I don't know a lot about this company, but the bottom line is the company has earnings, and I want you to notice there's a lot of volatility in the stock price, but the stock price at least is functionally tracking the earnings. And that's really the message I'm trying to get across here. The fundamentals matter. If I look at the fundamentals, I can see that, there was a lot of risk going on here. Earnings fell 61%. When I put price on the graph, the price reacted to that, but now earnings are rising like 140% coming out of COVID, and the stock price is rising. Now, I think it overshot it here, but the point is, in the long run, fundamentals rule, but you don't always have to wait 11 years. Here you're seeing the fundamentals, generate a reaction, and a rational reaction very, very quickly. And then Albemarle is one of my, better examples. I've actually written articles on this stock, and I've actually produced videos on this stock where, you have this is a lithium producer, by the way. You have this long history of the price tracking earnings. But again, look at all that volatility. I just kind of get across to you that these volatilities are unpredictable. Now, had you bought this stock, here, and let's say April of 2008, coming into the recession, and watched it drop, 48% by February of 2009, people would tend to hate that stock. But then most people would have sold out there only to watch their money, go up with earnings. And look how the stock price tracked earnings here, more than 2.5-fold over the next, couple of years or so. And then we have this huge drop. But if I'd have held it here or bought it here and went through all this volatility and held it to here, I'm making 10% a year. But that's most people don't have that kind of patience. They don't have the intelligent patience. Now, I wouldn't have been intelligently patient here, and I did publish a video on that showing that the stock was ridiculously overvalued, and in very short order. It didn't take me 11 years or even 3 to 5 years. In a matter of a year and a half or two, this stock, corrected, went way below intrinsic value. And then lo and behold, now Tesla's hot, and this is all about lithium and the lithium batteries. This stock from its bottom has had this, massive run up, more than doubled, the 1.5-fold increase in value just in a very short period of time. But those stock prices become very, very, risky. And, this stock ought to be trading at a significantly lower valuation than it currently is. But the point is, fundamentals are ultimately what makes stock prices go where they go in the long run. In the short run, you've got sentiment, which is that volatility that I've talked about here so much. And then, if you look at a stock like Aegon, life and health insurance, this company's produced very poor operating performance, and look at their stock price. Their stock price has reflected that. Okay, now in the short run, there's all kinds of volatility. There are short run periods of time where you could have, bought it and sold it and made, tripled your money over short periods of time. You're going to get a lot of those. One of my favorite mantras, and it's one that I believe I actually created, was that, and if I go back to Albemarle, I think it would actually be a better example to talk about it, that great investors are great mountain climbers. Stock charts are always talked about as mountain charts. Recognize that the only way you can get to the highest peaks is to be willing to go to traverse through the occasional valleys that come along. And stock prices always have peaks and valleys. Okay, but the earnings also have peaks and valleys in many cases. And in your best stocks, you have nothing but peaks. The earnings keep going up. But when you're looking at companies that have very, very weak fundamentals like Alcoa here, and you'll see this with a lot of heavy metal companies where their earnings go nowhere. They went from $11 a share in earnings in 2003 down to a loss of 99 cents and $1.16 in 2020. And of course, that means their stock price also went nowhere over this period of time. It's the fundamentals that rule, and you want to have intelligent patience patience simply means that you focus on the fundamentals first. You look at a name like Alexion Pharmaceuticals, it took a few years of being massively overvalued, and then it corrected over 2 or 3 years, and now it's moving back into alignment with fair value. It doesn't have to take 11 years, just like I showed you with Albemarle, but the point is that is totally unpredictable. Okay, you don't know. But in the long run, stock prices tend to go where the earnings go, and when they do get disconnected, you have to be patient. Like I would patiently wait to buy this stock again for the price to come back into alignment with fair value. In the meantime, I might look for other names. I might not ever be able to get this stock. And of course, there's Tesla. I don't think people realize what really has gone on with Tesla. If you say you bought Tesla in February of 2014, and you held it, and I'm purposely picking a bad time frame here, you could have held it till September of 2019. Okay, that's clearly more than 5 years, and you'd have actually lost money owning Tesla. Why? Because the company didn't make any money. They had negative earnings growth in 2015. They eked out a tiny little profit in 2014 and 2013. Then they lost big money in 2017, and now they're expected to eke out a penny they did eke out a penny in 2019, and then they're going to start earning money again. And the growth here, these growth rates are going to be pretty astounding, if you will. If you look at the forecast, Tesla's expected to grow at 25% a year. But the point is, you're paying 260 times earnings to buy that growth, and that growth does not justify this valuation. I don't care how much you like the Tesla car. I've done videos on Tesla, but nevertheless, and I can't deny this, I'll just pick a spot here. This stock has risen an astounding annualized rate of return of over 450% over the last 2+ years. That's awesome performance. I can't argue that. But the point is, there's no rhyme or reason for that. That's hype. Now, at some point, I believe I think you already are paying musical chairs with your money. At some point, you want to be careful that you don't see a complete reversion to the mean. Any little negative catalyst here, and this stock becomes, very, very vulnerable. And it doesn't always happen with these, hot names. I mean, you look at a name like 3M. Here's an overvalued period of time, and you went through several years of very poor performance with 3M. Then 3M strung together some pretty good earnings, and the more it did, the better the market liked it. And so, if you'd have bought it somewhere in here, let's say at fair value, and held it till it peaked, and were smart enough to get out, you'd have made 17% a year. But then from its peak, it didn't take 11 years. In a couple of years, it reverted to the mean, and you would have lost, 45% of your money from that peak to trough. Now it's rising again. Okay, but the point is, volatility in stock prices is nowhere near as important as what the fundamentals of the business has done. And that's what I'm really trying to get across here. Now, another one would be to look at a name like AMG. Now, I think this is interesting. My son's a growth stock manager. He likes to invest in growth stocks. This is a terrific little company, and they own a bunch of boutique money managers. And as you can see, there's a lot of volatility in the stock price. This is a classic example of overvaluation reverting to the mean, overvaluation reverting to the mean, the stock moving back into fair value, and then we had this huge collapse in price. They paid a dividend, even cut dividend. But look at the recovery we're having now. My son was watching the fundamentals. These fundamentals were weak, and they did, I would say, suggest, if you will, that the price should have been weak here, but this is way overshooting the weakness in the business. And now the market is beginning to recognize that. The company's looking like it's going to start earning money again, and you see the stock price moving dramatically back up. And of course, probably the classic example of that is the recent situation that went on with GameStop. But let's look at this first. Let's look at this from a standpoint of fundamentals first. Okay, so let's get rid of all the hype and hysteria that's happened in the last year or so, and let's look at fundamentals. There was a period of time when this stock was growing very fast. You can see the growth rates here were phenomenal, 30%, 70%, etc. And then they came into the recession overvalued, and the market corrected. Their earnings fell by 5%. They actually still were profitable, but their earnings dropped by 5% in in 2010. This is one of those examples of a January fiscal year. And then the stock price languished, and then all of a sudden it moves back into fair value. They start paying a dividend. They were increasing the dividend, very nicely during this period of time. But then, all of a sudden the business went south. Earnings went from, the $3 plus that they were making in 2017 down to 22 cents and expected to lose money over the next 2 years. But in spite of them losing all this money, you all know the story about the Reddit, etc., where everybody got excited and, traded this stock, and they drove this stock up, from December of 2020 to up through January of 2021. We're talking about, roughly a month's time here. This stock went up, just this astronomical amount. I don't even know what that number is. The annualized rate of return was 1,625% total return. And I don't even know what this is annualizing out. The math is almost undoable. But then from January, with no fundamentals supporting this, all of a sudden we had this stock drop virtually, almost 100%. In other words, a $10,000 investment would have turned into $3,130. That's losing money big time. Now we had this little, maybe we'll call it a dead cat bounce here, and then the stock is, is falling again. But the point is, there's no fundamental support. This is pure speculation, ladies and gentlemen. This is pure gambling that has nothing to do with fundamentals and investing, because in the long run, fundamentals will dominate and will rule. And so when you're looking at your common stocks and you're trying to make decisions what to invest in, just looking at the price, because here's a stock that would have given you all types of bad signals, types where the prices, the price had these really incredible rates of return, tremendous growth, and followed by these big losses. But if you'd have been looking at only the fundamentals of this stock, you might have never invested in it in the first place, but you'd have also recognized that the fundamentals were not, what you would want in a business if you were the owner of the business. They were very cyclical and actually shrinking over time. The long-term growth rate of this company has been minus 2.3%. But you also want to have intelligent patience, and there's nothing wrong with having intelligent patience. So, for example, if I look at, a stock that I personally like today, AbbVie, when you look at the oncology market and what's happening, and I look at this stock from a fundamental point of view, Humira is going to lose some ground here, but this company's got a great pipeline, and I expect their long-term growth rate to stay on track and begin growing again. But in the meantime, I can buy this stock at such an inexpensive valuation that, it almost, to me, I can't even avoid investing in this stock, because my rates of return just over the next couple of years could be very, very strong if this stock just goes to a 15 PE ratio. It's currently trading at 9 times earnings with a 4.5% yield, and it's a very strong company. Again, a very strong biotech company, and it has a lot of promise going forward. But I'm applying intelligent patience because I'm not so much focused on the stock price, which hasn't been good for the last several years, although it's starting to rally again. What I'm focusing on are the fundamental values. In the long run, the market's a weighing machine. In the short run, it's a voting machine. So I just want to give you the insights. Most people like a stock that's going up and hate one that's going down. And frankly, oftentimes, not all the time, oftentimes it's that stock that's weak would be the one that you really wanted to be investing in, because that's the one that's going to make you the most money going forward, not the one that's already risen to the point where you're playing the greater fool. You're foolishly paying more for the stock than it's worth on the basis that a fool greater than you is going to come along. I hope you enjoyed this little presentation here on intelligent patience, and the real point being that it takes time for companies to build value for you. Give them time, buy them at good values, focus on the yield, the growth, and the value that you're looking at, and in the long run, you're going to do great. Anyways, it's been Chuck Harwell saying thanks for watching. Give me a like, ring the bell, give me a thumbs up, subscribe to the channel if you haven't. I hope you enjoyed looking at this, preview of our new software. By the way, there's a lot of things broke on it, so a lot of things aren't working yet, but we're rapidly getting there. We unfortunately had one of our top developers come down with the dreaded COVID disease, but we expect him to be back in the saddle here, hopefully early next week. He's starting to recover, and we wish him and his family all the best. Anyway, thanks for watching. Appreciate y'all. I'll be talking to you again real soon.